Ladies and gentlemen, thank you very much for having us here today to talk to you. We appreciate the opportunity. To my left here is Jason, Alan, and David, and my name is Alex. We understand that you have invited us here to talk to you today about two current crises that you're facing. The liquidity issue due to one of your major depositors withdrawing his position, and takeover or an acquisition proposed by Shoppers Drug Mart, and how to maximize shareholders' wealth with that bid. We believe that you have several issues that you need to handle. First of all, is our cash position right now able to cover this depositor's position? Secondly, are our cash reserves sufficient for our reserve ratio? And third, do our balance sheet and capital ratios go offside in the medium to long term? Some sources of immediate cash that you can draw on. Your cash on hand and your liquid marketable securities are obviously the first two places that you're going to go. That's $447 million that you can draw on. Right now, your deposit base is sold through 40% big banks, 40% mid-tier banks, and 20% mom and pop shops. Based on our best estimates, you do not have a single depositor that will be greater than this $447 million. However, if our estimates are wrong, there are other sources that you can go to. You can go to interbank lending. This has been the traditional source for overnight cash between banks. You can also you can contact your large institutional investors and insiders for financing. We know that this is possible because your CEO a couple of weeks ago got a margin call and was able to satisfy demand for 100,000 shares overnight. You can also seek an intermediate mezzanine bridge loan, or as a lender of last resort, you can go to the Bank of Canada, although we don't have any record of you having a previous relationship with the Bank of Canada. Regardless, you are going to need cash in the medium to long term to, you are going to need cash in the medium to long term, and Jay is going to discuss some of the ways that you can achieve that.
Once we've dealt with the immediate pressing short-term cash crisis, we have to focus on the longer-term cash issues. Obviously, if we're in the middle of a cash crisis, we cannot have funds flowing out of the business, especially funds that we have control over. So we must temporarily halt new loans and reevaluate the cash condition until we're satisfied that it's taken care of. Then to raise more cash, we have to offer an incentive to depositors to buy our products and deposit with us. We believe a GIC with higher rates will bring in the extra funds. It was mentioned earlier that a 16 basis point increase in rate brought in over $200 million from a depositor network in 1 month's time. Thirdly, we have to incentivize the broker-dealer network to sell our product versus our competitors. Currently, brokers are earning 25 basis points commission on GICs and deposit products on our products. We believe by upping that to 30 basis points or 40 basis points, that will strongly incentivize our broker-dealer network. Thirdly, we have a $100 million open prospectus for subordinated debentures, C-notes, 9%. We currently have issued $55 million of that, and we have $45 million that we could push through and issue to raise cash to take care of the cash crisis in the medium term. To sweeten the deal, if it was necessary, we could add a warrant and increase the finder's fee to get that issue out the door. Finally, we have to examine who we're doing business with. This is a key issue. We need stable partners. We've got to understand our counterparty risk, and we really got to take a look at who we're dealing with, because their financial stability impacts our financial stability. In addition to the cash crisis, an outflow of cash reserves will impact our regulatory mandated reserve ratios, total risk-adjusted capital, and Tier 1 ratios. These are regulatory determined and are critical to the operation of the bank. First and foremost, we believe we have to increase investor and depositor confidence by hiring an investor and relationship management firm. If another broker-dealer does go broke, if we have a good reputation and strong relationships, we will be able to possibly find another one of our broker-dealers or partners to take the bad loan book and take care of the situation. Secondly, we have to rebalance our loan portfolio in the medium to long term to increase the spread that we're earning, to increase our earnings. This will improve our various Tier 1 and total risk-adjusted capital ratios in the long term. And finally, if need be, we need to rationalize our investments in Discovery Air and VersaBank to raise funds and improve our business's focus. And looking at the timeline, in the first 1 to 5 days, this is the most critical timeline. If we do not meet our demand cash requirements, that could make or break our company. This is where we're focusing on cash, our marketable securities, and interbank lending. Over the next month, we need to stabilize our cash position and ensure this is not a reoccurring problem. This is where we'll push out the debentures, increase the commissions on our products, and incentivize the broker-dealer network with higher commission rates and GIC rates. Over the medium term, 1 to 3 months, this is where we'll focus on improving the balance sheet and the various ratios. This is where we'll begin looking at rebalancing our lending portfolio, look at our partners, create new relationships, and possibly rationalize the non-core businesses to raise funds. By following this mitigation plan, we feel we can effectively manage future cash requirements and crises into the future.
We understand that Shoppers Drug Mart has also submitted an all-stock takeover bid for your firm. The key issue that we've identified here is how can the board and management team maximize shareholder value? We've conducted a comparable analysis, and it shows that your company is undervalued relative to its peers. We feel that you need to conduct a thorough fundamental analysis to determine a premium that reflects your company's intrinsic value. Our sensitivity analysis here show the implied share prices from various premiums. Our gut feel is that you need a premium of about 40%, or about $4.34 per share. Precedent transactions show that companies typically pay about a 30% premium. However, we feel that your share price, your company is undervalued, and therefore we suggest that you seek at least an additional 10% to compensate for that. Again, I'd like to reiterate that this is a preliminary analysis, which is why we're suggesting you do a rigorous fundamental analysis to determine your intrinsic value. We know that Shoppers is offering a significant premium. However, this premium is over a distressed share price. The effect is further amplified because Shoppers' common shares has held relatively flat, while your share prices have declined significantly on a relative basis. Other factors to consider include the upside potential for you as a shareholder of Pacific Western Credit Corporation as an independent identity, and also as the owner of the combined entity. You need to consider from both perspectives. As a previous graph showed, current market conditions tell us that the market is lacking in confidence in the financial services firms, and the shareholders, through this opportunity, will have a chance to own a larger, more diversified, and less risky firm. This acquisition proposal also implies a dilution of your real option to VersaBank, which is potentially a very profitable real option to Basel II compliance in the United States. Also, as shareholders, you will have to be ready to accept that sale of your company to Shoppers Drug Mart would likely result in the sale of Discovery Air, because we feel that there aren't enough synergies for Shoppers to keep Discovery Air as part of their business.
Thanks, Alan. So we've already stated that we have to establish an analysis of your company and what it would be on a standalone basis, and we feel you as a board and a management team already have a good handle on your upside. So we wanted to take a look at what would taking ownership of Shoppers Drug Mart shares mean for you and your shareholders, since that's how we're being paid in this case. Over the past 6 years, Shoppers Drug Mart has had an extremely good and growing return on equity, and they've also shown a similar trend in earnings per share, growing that at 11% compounded annual growth rate. This shows they've had solid execution of their business model and a strong history of shareholder value creation. But what upside potential is there? They already have, we've proven they have a strong execution on their business model. They have a history of growing their retail distribution by opening new stores and consistently increasing their same-store sales year over year. Into the future, They have stated they're expanding into Quebec to compete directly with Jean Coutu. They're also planning to open 150 new format stores targeting medical professionals and hospitals. This is a subtle synergy to PwC's business of lending to hospitals. Perhaps there's some relationships that could be leveraged in this case. Also, as Alan has already stated, ownership of Shoppers Drug Mart is a lower risk investment for your shareholders compared to you. It is less sensitive to the economic cycle. Your investors might appreciate this in the current situation, where your share price has declined by, I believe, over 61% year to date. So what does the strategy look like going forward if the two companies are combined? We know that the bank and retailer model is proven within Canada. We see that it works with Canadian Tire and with President's Choice. They both have successful retail banks operating there. Also, the retail branded credit card initiatives that you have identified as part of your strategy fit well within this, especially considering that Shoppers Drug Mart has a loyalty program. You could combine both of those and increase credit card transactions because people were earning loyalty points and increase sales at Shoppers Drug Mart through one product. So the immediate timeline on this merger and acquisition scenario is, of course, we have to press release this offer to the public and to our shareholders and state that the board is beginning its review process. This should be done immediately. Next, because every board and management team has its own biases about valuation for their company and the upside, we should hire an independent valuation to be done by an investment bank or other certified business valuator. Once this has been properly reviewed by the board and the management team with the financial advisors, we should press release the details of this offer and the board's stance probably within about a week to the public and the shareholders. Following on this, we need to build and follow up with an investor relations campaign, either supporting the bid or not supporting the bid, depending on the stance that we take. If you are receptive to the bid and you feel that the premium is significant for your company, then issue a fairness opinion to that and tender to the offer. Obviously, you feel that sharing in Shoppers Drug Mart going forward is the best strategy for your shareholders. If, however, you're opposed to it, simply state that to your shareholders. Begin by contacting your institutional shareholders, looking for support there, finding out if you'd have buying support or if they would be willing to tender to the offer if the board was in opposition. Then look at other strategies if they were necessary, such as a shareholders' rights plan, possibly reinstating the normal course issuer bid, or possibly going to look for a white knight or somebody else who might be interested in purchasing your company for a more a value closer to what you determined was intrinsic. Thank you very much for your time today, and we'd like to invite any questions that you have at this time.
I've got a question. I'm interested in your timeline for addressing some of the key liquidity challenges, and you had them broken down over different time periods. The first one was 1 to 5 days, quick cash. I'm not clear exactly how you were going to address that, what recommendations you would make. You outlined a few points in terms of incentivization of brokerages and perhaps looking at higher rates on GICs. Are those them, or could you clarify that for us?
I'll take that. Within the first 1 to 5 days, it was within the several weeks that we would incentivize the GICs and the brokers. Within the first couple days, that's where we would focus on using our existing cash reserves to meet the cash shortfall. Also looking to liquidate our securities portfolio, which included T-bills and high-quality corporate debt in very liquid markets, and also talk to other banks and lenders and possibly set up an interbank loan. So that was our short-term strategy to cover the immediate shortfall within the first several days.
I have a question. In terms of the recommendation around should you or should you not, or should we not accept the shopper's bid, if the premium is sufficient, what is your point of view on that?
If the premium is sufficient, we think that there is added value to your shareholders by tendering to the shopper's bid, because not only do you make the premium immediately, but you also share in a company that has a strong history of growth to its shareholders and has several initiatives that will provide upside into the future. So we think you should go with it if you determine the premium is adequate.
Just a follow-on question. If you do that, in your recommendations around the first crisis, you were citing divesting the credit card portfolio because it was a non-core asset, and yet the primary synergy with Shoppers is really around the credit portfolio. Where do you see the growth in the company in terms of those two halves of the business?
We actually believe that the credit card portfolio was not one of our disposition candidates.
Okay.
We were looking at disposing of possibly the Discovery Air
Okay.
equity investment as well as the VersaBank software package and vending that out to third-party strategic partner or selling it outright.
Okay.
So the credit cards we wouldn't touch.
Could I just follow up on that, on those two last questions? You have, I think, a very interesting analysis of the synergies that might be obtained by Shoppers Drug Mart acquiring this bank. But going forward, assuming that those synergies produce some real intrinsic value, that value will be shared by the bank's shareholders who are now Shoppers shareholders with all of the other Shoppers Drug shareholders. Did you look at all or consider whether those same synergies might be obtained by partnership arrangements or other arrangements with a retailer that might preserve more of that increase in value or potential upside for the shareholders of the bank itself?
You are correct in saying that some of the value upside would be taken by existing Shoppers shareholders and not by our own PwC shareholders. That is the intent behind a stock offer. However, if the premium is significant, we feel that your company has obviously, based on market performance as of, let's say, year to date, it has been significantly down. That shows that the market is feeling your securities are highly risky. So pursuing a partnership agreement and that kind of stuff, while there might be some merit to doing that if the premium wasn't significant enough, if Shoppers is willing to pay what you determine is an adequate premium, then really you're getting to share in all that upside for less risk to you as a shareholder, because you don't have to go out and establish those relationships, and more importantly, you don't have to have the continual exposure to this more volatile security into the future.
But yet you're measuring the premium against the current market price, and I think, as you point out, the current market price is very, very depressed, both historically and compared to peers. I find it difficult to see how you could really capture the upside potential with the synergies that you talk about in terms of merely a premium on such a distressed share price.
If I can just add to that also, I guess the trade-off is if you do go and try to partner with another firm, you have to realize that you as a company is a lot smaller than Shoppers Drug Mart. Shoppers Drug Mart is a $10 billion company, and being that kind of a large company, there are certain things that they can do because of their size that you will not be able to do. So from that perspective, it may also be beneficial to be acquired under Shoppers. As well, as Dave mentioned, this is, we perceive it at least, a less risky approach.
What's your thinking on how the first issue with losing a major depositor, which probably isn't necessarily reflected in current market price, what do you think that does to value? Did you factor that in looking at the value and the premium?
We were asked to evaluate the two situations independently, so we did not do that.
Again, on your first issue, you talked, I believe, and maybe I misheard, about rebalancing to increase risk in the portfolio somewhat in order to increase the spreads and improve profitability in the future. What types of directions were you looking at when you were talking about doing that?
Well, first of all, the credit markets, the spreads have been widening because of the lack of capital to loan out. So people are now paying for risk whereas they wouldn't. So we believe you would on balance, be probably having still a very low-risk portfolio. But by capturing some of the higher risk assets, such as, well, on the low-risk side, you'd have insured mortgages, those sorts of things, project finance facilities with things such as hospitals that are very unlikely to go broke because they have large government support. On the other side, you'd be taking on things such as the credit card receivables, the credit card business. We're not asking that you go and buy Hollywood distressed housing debt and take on the most extreme risky assets, but we're just asking that you use a portfolio strategy and knowledge to have a number of uncorrelated loan relationships, and then you could capture more of the yield without significantly increasing your risk profile and improve your profitability there as a result.
What, in terms of back to the first issue on the depositors, what advantage do you see the Pacific and Western has in terms of keeping and attracting its deposit base long term?
I have two responses to that. First, sorry, in the short term is that they have a lot of cash. In the long term is that they have a lot of non-risky assets with stable cash flows.
To add to that as well, they also have the Schedule 1 license, so everything will be insured under the GIC plans to the investors.